welcome back to the deep dive. If you are here, you're probably interested in what feels like the absolute frontier of finance. We're talking about something that has been generating, just a massive amount of buzz and honestly, even more debate. Tokenized real estate.
Absolutely.
This market promises this revolutionary blend of innovation, global accessibility, and fractional ownership. It sounds like the perfect financial dessert, but is it actually safe to eat?
And, that excitement is absolutely justified. It's not just hype. Tokenization solves some really fundamental historical problems that are just inherent in property investment.
Right. The old barriers.
Exactly. But before anyone gets swept up in that, that compelling promise of owning a piece of a skyscraper for $100, we have to acknowledge the critical reality.
Okay.
Our mission today is necessary, it's critical, and it's really the difference between success and disaster here. We have to conduct a deep exploration of the risks and the rewards.
So it's not magic.
Tokenized real estate is not magic. It's a hybrid asset class, a complex financial sandwich, if you will.
I like that, a sandwich.
Where, the bread is the stable physical property you can see and touch, but the filling is the volatile, decentralized blockchain technology.
Yeah.
And that hybrid nature, that's what introduces complexities that traditional real estate investors never, ever had to worry about.
That's right. And we've got a stack of analysis here that confirms this. This is a space where you need to be extraordinarily prepared. We're talking about compliance questions that change, literally from one jurisdiction to the next. We're talking about major valuation challenges that stem from that dual nature you just mentioned.
The on-chain versus the off-chain.
Exactly. Huge liquidity concerns, even though liquidity is the big promise.
Yeah.
And yes, the kind of market volatility you normally see with, early stage crypto.
All tied up with the slow, steady world of traditional property ownership. It's a strange mix.
It is.
And if you, the listener, don't thoroughly understand those nuanced risks, you are not investing. Let's be very clear. You are gambling.
Right.
The goal of this deep dive is to give you the framework to tell the difference. We will break down the specific risks, the regulatory tightrope, the valuation dilemma, and the liquidity trap in, plain, approachable English.
And then we'll hit the rewards.
Then we'll discuss the compelling rewards that keep professional investors engaged. And finally, we will leave you with a practical, specific 7-point checklist for due diligence that you can use immediately.
So we're not just celebrating the future of finance today. We're putting on our highly critical lens.
We have to.
Understanding these unique risks is the absolute foundation of successful investing in this new world. And since the foundation of any investment is whether it's legal in the first place, let's start right there. Let's unpack the foundational uncertainty, the regulatory tightrope.
We have to start there. It's the single biggest challenge defining the risk landscape in this hybrid asset class.
Sure.
Compliance. Tokenized real estate sits in a very, very complicated legal area. It doesn't neatly fall into one historical box, which means it is constantly navigating an intersection of three vastly different and often contradictory legal fields. This is the source of profound risk.
And that's the complicated triangle of regulation we need to explore. So, on one side, we're dealing with traditional securities law.
Right. The rules that dictate how capital is raised, how investment contracts are offered to the public, all of that.
Then we have traditional property law, the old school stuff.
The really old school stuff. This governs the physical asset itself. The deeds, the titles, the local zoning.
And finally, the brand new, often shifting world of blockchain regulation or digital asset laws.
Precisely. And let's consider how those three fields intersect. Let's use a common legal framework like the Howey test in the US.
Okay, for our listeners, what's the quick version of that?
The Howey test basically determines if something is an investment contract and therefore a security. It asks if you're investing money in a common enterprise with the expectation of profit primarily from the efforts of others.
So if a platform is managing the property for you and you're just collecting rent checks.
Exactly. If a tokenized offering promises returns based on the efforts of a third party, the property manager, the platform itself, that token is very, very likely a security.
And that triggers a whole cascade of rules.
Instantly. It triggers complex reporting, registration, and restriction requirements under securities law. But here's the twist. Simultaneously, the underlying asset, say an apartment building in Chicago, is still governed by local property law in Illinois.
So you still need physical deeds, you need to pay local property taxes, follow specific rules for tenancy and eviction.
All of it. And then that third layer blockchain regulation manages the tech. It governs the platform that issues the token, the rules for digital wallet custody, and the mechanics of how that token is transferred on the blockchain itself.
So all three of these legal regimes have to be satisfied perfectly.
Perfectly. And they can conflict. If the digital asset laws in, say, Germany restrict the type of blockchain that can be used, and that specific blockchain doesn't meet the property law requirements in Florida for a clear ownership transfer, well, the whole structure fails.
The whole thing just falls apart.
It does. Now, here's where it gets really interesting and complex for you, the global investor. Geographic uncertainty.
Okay.
The rules change dramatically based on two major and sometimes conflicting factors. First, where the property is physically located. A warehouse in London faces entirely different rules than a condo in Singapore.
And second,
where the investor U is located.
Okay, this dual geographic complexity needs more attention. Let's use a specific scenario to highlight this. Say I'm an investor in Canada.
Okay.
And I'm buying a token that represents a fractional share of an Italian vineyard.
A classic example.
And the platform that issued the token is based in the Cayman Islands. So, which securities regulator is in charge here? Who's the dominant one?
That's the million-dollar question. And the answer is, the platform's compliance team has to prove they satisfy all three jurisdictions. It's not an either-or.
Wow.
So Italian property law governs the deed, the land use, and the local tax structure for that vineyard. The Cayman Islands law governs the issuance of the token and the corporate structure of the platform itself.
But what about me in Canada?
Right. Canadian securities law dictates whether you, as a Canadian citizen, are legally permitted to invest in that specific type of token and what disclosures must be made to you.
So if the platform only focused on their Cayman compliance,
they're ignoring the fact that they are marketing an investment product to Canadians, which could be illegal. And that puts you, the investor, at risk of violating your own country's investment rules, maybe without even knowing it.
that is a massive geographic challenge. And I imagine that's why this regulatory divergence is such a profound risk.
It is. The landscape right now is incredibly messy. There is zero global standardization.
So everyone's just making it up as they go.
In a way, some countries, recognizing the risks, treat tokenized real estate explicitly as securities. This places heavy restrictions on who can invest.
So they limit it to, what, accredited investors?
Yeah.
High net worth individuals?
Often, yes. Which immediately contradicts that whole promise of universal accessibility we just talked about.
Right.
Other countries are viewing it as a distinct digital asset, which might fall under lighter, more favorable frameworks. And that often creates what's called regulatory arbitrage.
Where platforms shop for the easiest jurisdiction to set up in.
Exactly. And crucially, some jurisdictions simply have no clear rules yet. There's a vacuum of uncertainty. And that's where many new projects launch, hoping to move fast. But, relying on the absence of rules is highly dangerous.
Because the rules will arrive.
They will arrive, and they might even be retroactive.
And that uncertainty, that's the risk itself. But wait, isn't that a contradiction? You're saying the whole promise is accessibility to the average person. But if the token is treated as a security, that might mean only the wealthy can legally invest.
That is the core conflict, and it's something that platforms have to navigate very carefully. It often requires them to segment their market rigorously.
What do you mean by segment?
They might promise global accessibility, but if they operate under a securities framework, they are either taking a huge legal risk or they are blocking investors from certain countries. So you might find yourself excluded from a really high-quality project purely based on your zip code.
Wow.
Now, imagine a worst-case scenario. A project launches, relies on the current light touch regulation in its home base, and then a major regulator, say the SEC in the US or an equivalent European body, decides to change its stance on the entire asset class.
The consequences of that would be severe. And you're saying this isn't just a hypothetical?
Not at all. We saw this happen during the ICO boom a few years ago. If regulators decide that a certain token or platform structure is non-compliant, platforms may be forced to freeze trading instantly.
So you're stuck.
You are stuck holding an asset you cannot sell. That promised liquidity just turned into an immediate total lockup.
What else could happen?
They may also be required to reissue all the tokens under a stricter compliance regime. That's costly, it's slow, it's incredibly disruptive for everyone.
In the absolute worst case.
In the most catastrophic scenario, and we have seen historical examples in failed investment schemes, regulators could force the platform to completely unwind the deals.
Unwind them how?
By forcing the sale of the underlying physical asset, the building, the vineyard, to return capital to investors. And that forced sale often happens under duress, a fire sale.
Which means you're probably not getting your money back. Not all of it, anyway.
It could result in a price that significantly erodes or even wipes out investor returns.
That sounds like a nightmare scenario for the investor. You take a seemingly stable asset, real estate, and it becomes this highly volatile, inaccessible thing overnight. This brings us to what feels like the most critical red flag in this whole discussion.
It is a critical risk, and it brings us to the first fundamental rule of investing in this space. Never, ever invest based on vague assurances.
So if you're looking at a project
and the team cannot clearly and articulately explain its specific regulatory framework, which laws apply, in which jurisdictions, and exactly how they achieve compliance, that project is a non-starter.
What if they say things like, it's an evolving space?
If they waffle or say, we're working with lawyers, that is simply a declaration that they are operating in a legal gray area, and you will be the one holding the bag when the regulations finally catch up. You have to demand precision.
Okay, so let's say we've found a project that is crystal clear on compliance. We've navigated the legal structures. Now we have to ask the most basic real estate question of all. What is this property actually worth?
Right.
This is already complicated in the traditional market, relying on expert judgment and comps. But tokenization, it seems, adds a dangerous extra layer.
It does indeed. Traditional real estate valuation is an art and a science, and it relies on several fundamental metrics that have been established for decades.
Like appraisals.
You rely on independent appraisals conducted by certified, state-licensed professionals who physically inspect the property. You look at comparables or comps, recent sales prices of similar properties in the immediate area.
And income.
You analyze the income generated by the property, and you evaluate capitalization rates or cap rates, which are, perhaps the most essential metric for commercial or income-generating property.
Okay, let's briefly ground the cap rate for the listener, just to be clear.
Sure. The cap rate essentially measures the expected rate of return on the property investment based purely on its net operating income, or NOI.
So it's income divided by price.
In simple terms, yes. For instance, if a property generates $100,000 in income annually, and the market values that property at $2 million, that's a 5% cap rate.
And why is that so important for a token investor?
You need to know that the tokenized asset's stated performance aligns with the market's expected cap rate for that specific region and property type. If the platform claims a 9% yield in a neighborhood where 5% is the standard, you must immediately question their valuation or their income projections. Something isn't adding up.
Okay, but tokenization introduces this hybrid valuation layer that complicates all of that, even if the underlying asset is valued perfectly. We're talking about a potential for a massive divergence here.
That's the core dilemma. We have a fundamental tension between the on-chain price versus the off-chain value.
Explain that difference.
The off-chain value is the real-world traditional appraised worth of physical building, calculated using those comps and cap rates we just discussed.
The real value.
The real fundamental value. The on-chain price, on the other hand, is simply what the token is currently trading for on a digital exchange. And that's driven by supply and demand dynamics, which can be potentially unrelated to the property itself.
So conceptually, the token might be trading at, say, $1.20. And that could reflect massive investor enthusiasm, market hype, maybe even a promotional bubble.
Right.
But the independent appraisal of the physical property says the underlying asset only supports a 95-cent token price.
In that scenario, the token is trading at a premium of more than 25% over its true fundamental value. You're overpitting.
And it could go the other way.
Absolutely. The market might be depressed due to, say, generalized crypto fear or just poor short-term liquidity, and the token trades at 80 cents. Meanwhile, the property's true worth is higher, meaning the token is trading at a deep discount.
And that disconnect is the primary danger.
It is, because investors might confuse the trading price with the actual value of their investment. They see the token price moving up and believe their asset is appreciating, when in fact the movement could be purely market noise.
And why does this disconnect happen so easily? I assume it's because these tokenized markets are still young and fragmented.
Exactly. They often suffer from what we call thin trading volume.
Meaning not a lot of buying and selling.
Very little. In a thin market, liquidity is poor. This means that even a small trade, Someone buying or selling, say, $5,000 worth of tokens can cause the on-chain price to swing significantly, sometimes by several percentage points.
So the price isn't really a reflection of value anymore?
The token price then becomes a measure of immediate market sentiment and available liquidity, not necessarily a reflection of the fundamental, stable property price. This makes the token vulnerable to manipulation or just irrational exuberance simply because there aren't enough buyers and sellers to smooth out the price action.
So the volatility we see isn't necessarily about the building being foreclosed on or the roof leaking.
Not at all.
It's about the financial mechanism used to trade the shares of that building being fundamentally fragile because of low volume. That's a crucial piece of context.
That's right. And this is why the due diligence red flags around valuation are so critical. Investors must demand independent third-party valuations.
No in-house numbers.
If a platform is using in-house valuations, or if they claim the price is based on some internal model without verifiable input from known, reputable, certified appraisal firms, that is a huge red flag. You need objective external proof of the off-chain value.
And the frequency of these updates.
Yeah.
That has to matter just as much as their independence.
Oh, absolutely. Real estate values don't sit still, especially if a property is generating income or undergoing major local economic shifts. Think of a new subway line being built nearby, or a big company moving its headquarters into the neighborhood.
That would change the value.
Dramatically.
Yeah.
So the frequency of updates is a non-negotiable transparency point. You have to inquire, are new valuations provided quarterly, annually,
Yeah.
or only when a major event occurs?
What's the red flag answer there?
If the platform updates when they feel like it, or worse, only when they need to raise new capital, which is when they want the valuation to look high, that signals a profound lack of transparency and investor care.
Because you can't make good decisions.
For an income-generating asset, receiving infrequent valuation updates severely limits your ability to assess performance accurately. It means you don't know if you're buying at a premium or a discount relative to the actual real estate value right now.
Okay, let's move from that long-term value to the short-term price behavior. Traditional real estate is seen as, the anchor of stability in a portfolio.
The bedrock.
Exactly. You might see slow, steady appreciation over years, maybe 2 to 4% annually. Volatility, especially sharp price drops, is usually a sign of a distressed market or a full-blown financial crisis. But tokenized real estate, as we've established, is a wild hybrid.
It really is, because it inherits the nature of both of its parents. While the underlying physical property maintains its stable, slow-moving behavior, the token itself can behave much more like a digital asset.
Especially in these early markets.
Particularly in early markets. And this is where many traditional real estate investors get completely blindsided.
Okay, let's deeply unpack this hybrid volatility. You could own a token representing a fractional piece of a really stable apartment complex in Dallas. The rental income is rock steady, the tenants are reliable, the building's in great shape.
A perfect, boring, wonderful asset.
Yet the price of your token might swing 10 or even 15% in a single week. How does that happen?
That massive swing is purely due to the market dynamics of the token, not the fundamentals of the physical asset. We're talking about things like general crypto sentiment.
So if Bitcoin falls 20%.
If Bitcoin falls 20%, even tokenized real estate, which has a fundamental anchor, can suffer collateral damage as panic investors just liquidate digital holdings across the board. They sell everything.
And the low liquidity we just discussed.
That's the other driver. As we discussed, in thin token markets, low liquidity means that a single large seller or buyer can drastically move the on-chain price all by themselves.
This creates an instability that traditional real estate investors are simply not used to seeing. The property didn't change at all, but your liquid asset value, the token, has plummeted.
The token has essentially inherited the short-term speculative volatility that's typical of early cryptocurrency markets, even though its underlying security is a physical, tangible asset.
So the crucial analysis for investors then is to differentiate the cause of that price movement.
Yes, you have to ask. Are the price fluctuations being driven by fundamental changes to the property or the local market? A change in interest rates making debt more expensive, a sudden drop in occupancy, a neighborhood decline?
Or is it something else?
Or is it simply low trading volume making the token price jumpy? Is it just broader crypto market sentiment?
And if the volatility is purely market-driven due to low volume and thin trading?
Then it's a clear liquidity risk, even if the underlying asset is fantastic. And that brings us to the real double-edged sword of tokenization. liquidity.
The big promise.
The promise of tokenization is that it offers game-changing liquidity, the ability to buy and sell real estate quickly, instead of waiting 6 months, engaging lawyers, paying massive closing costs.
All for a traditional property closing.
You can liquidate your fractional ownership in moments, sometimes on a decentralized exchange. That is the massive reward. That's the feature that truly democratizes access.
And it is a huge advantage over traditional property. I mean, no one can deny that. But here is the stark reality, which is the risk side of that coin.
The reality is that not all tokenized assets are liquid. And this is where due diligence is absolutely paramount.
So some are liquid, some are not.
Some projects launch with great fanfare, and they do develop active secondary markets where trading is frequent and robust. And that means you can exit quickly at a fair price. But many, many others barely trade at all.
And what happens then?
If the secondary market is illiquid, meaning few buyers and sellers, low daily volume, and you need to exit quickly for whatever reason, you are essentially trapped in an asset that promised you freedom.
So if you absolutely must sell,
you may be forced to accept a steep discount, a massive loss of capital just to find a buyer, even if the underlying property remains perfectly sound and the cash flows are fine.
this is the critical moment for due diligence then. Before investing, you have to ask what sound like 4 essential liquidity questions.
Yes.
And these questions, they determine if the promised reward of a quick exit is actually available, or if you are entering a high-risk, illiquid environment that's just masquerading as a liquid asset.
These are the litmus tests for market health. First, how many buyers are in the market?
Why does that matter?
You need to understand the depth and breadth of the demand. Is this a handful of large institutions who might disappear suddenly if their strategy changes? Or is it a broad base of thousands of small, geographically diverse investors?
The broad base is better.
A broader, more decentralized base usually signals healthier, more stable, and more resilient liquidity.
Okay, what's the second question?
Second, what is the average daily trading volume? This is the hard, cold data. And you need to look at trading history over weeks, not just the last couple of days.
And what are you looking for?
If the volume is low, say consistently just a few $1,000s a day, and you need to sell $50,000 worth of tokens, you will completely overwhelm that market. You might crash the token price simply by placing your sell order. High daily volume gives you confidence that there are consistent buyers and sellers there to absorb your trade without undue impact.
Makes sense. Third question.
Third, are there market makers present?
Define market makers for us.
Market makers are entities, often professional trading firms, that ensure stability by constantly offering to buy and sell tokens. They are essential liquidity providers. Their job is to narrow the gap between the highest price a buyer is willing to pay,
The bid.
and the lowest price a seller is willing to accept, which is the ask. Their presence is a sign of a mature, supported market that is trying to offer real-time trading access.
And that leads to the fourth question about that gap.
Exactly. Fourth, how wide are the bid-ask spreads? This is the ultimate instantaneous indicator of market health, and it's directly related to the point about market makers.
So the bid is the highest price a buyer will pay. The ask is the lowest price a seller will accept.
And a huge widespread between those two numbers indicates a thin, risky market where transactions are infrequent and finding a fair price is difficult.
How wide is too wide?
If the difference between the bid and the ask is wide, say 5 or even 10%, it means the moment you buy, you are immediately losing 5 to 10% in potential value.
Because that's the gap between what you paid and what you could instantly sell it for.
Precisely. It signals that no one is willing to stabilize the market. You are essentially paying a massive hidden premium just to enter or exit a transaction. Thin markets with wide spreads can trap investors, turning that perceived benefit of liquidity into a major, costly risk factor.
We've spent a necessary and I think extensive time on the risks. The regulatory landmines, the valuation disconnects, the liquidity traps.
We had to.
But those risks are balanced by some really significant transformative advantages that are making tokenized real estate so attractive to modern investors. If the rewards didn't outweigh the serious effort of due diligence, well, no one would be paying attention.
That's absolutely correct. The risks we discussed are complex, yes, but they directly address profound pain points that are inherent in traditional property investing, pain points that have historically shut out the vast majority of potential investors.
Right.
Tokenization solves those old problems elegantly. It fundamentally shifts who can access real estate wealth.
Let's start with the most fundamental paradigm shift. Reward number one, accessibility. This feels revolutionary. It speaks directly to the democratization of finance.
It's a total game changer.
In traditional real estate, you need hundreds of thousands of dollars just for a down payment. You often need massive loans, specific accreditation, or high net worth status.
Tokenization completely obliterates that high barrier to entry. Instead of needing $100,000, investors can start fractional ownership with as little as $100.
And that opens up a different class of properties.
It opens up prime real estate markets. Think high-end commercial buildings or stable logistics centers, things previously reserved for institutions or the very wealthy to nearly anyone globally. It allows investors to build highly diversified portfolios without massive starting capital.
That leads right into reward number 2, global diversification. This is one of the most powerful features for serious portfolio construction.
It really is.
I mean, think about the complexity of trying to buy a rental property in Zurich or Sydney if you're not from there.
It's a nightmare. You need local lawyers, local banks. You might have to set up complicated holding companies that comply with foreign law. You're navigating unfamiliar tax and transfer laws, all while managing foreign currency exchange risk.
It's a full-time job.
Tokenization simplifies this dramatically. You can own fractionalized property in multiple countries. This allows you to diversify your portfolio across different currency exposures, different national economic cycles, and different property sectors.
All from your laptop.
Without ever navigating complex local brokers or physically visiting foreign banks. The ownership is tracked digitally, managed centrally by the platform's legal entities, those SPVs we'll talk about, making global asset allocation feasible, quick, and relatively low cost for the average investor.
Okay, reward number 3 is enhanced liquidity. And yes, we did just spend an entire segment talking about the risks of illiquidity, but we need to keep this in perspective.
Right, it's all relative.
We are comparing two extremes. Even imperfect, sometimes thin liquidity in a tokenized market is still vastly superior to the months-long, inflexible sales cycles of traditional real estate.
Oh, there's no comparison. You're comparing minutes or hours to sometimes 6 or even 12 months of escrow, inspections, financing delays, things falling through. Traditional real estate is the very definition of an inflexible, illiquid asset.
So tokenization fundamentally changes that.
It offers a path to a quick exit that simply did not exist before. If you suddenly need capital for an emergency, having the option to liquidate your fraction, even if it's at a slight discount because of a wide spread, is a massive functional improvement over being locked in for half a year or more.
Okay, reward number 4, transparency. This is a huge one, and I think it's often underestimated. It comes directly from the underlying blockchain technology.
It does, and from the use of smart contracts. The immutable nature of ownership records secured by the blockchain means that the history of the token and the claim on the asset are transparent and auditable by anyone.
What does that mean in practice?
Every fractional ownership stake, every single transfer of that token is recorded on a distributed ledger. Now, while the legal ownership still relies on the traditional structure, the SPV, the digital record of who owns which fraction, is secure, verifiable, and cannot be retroactively changed.
So it reduces disputes.
It massively reduces disputes over ownership stakes and adds a layer of trust that old paper-based systems just cannot match.
And finally, reward number 5, automation. This is the operational game changer. This is what moves traditional paper-shuffling real estate management into the 21st century.
This is a big one. Through the use of smart contracts, which are just self-executing agreements whose terms are written directly into code-tedious management tasks, are streamlined and made instantaneous.
Like distributing rental income.
Exactly. Rental income and cash flows can be distributed automatically to token holders based on the pre-programmed contract rules, all proportional to their token ownership.
So no one needs to press a button.
It removes manual accounting, it eliminates administrative delays, it reduces administrative costs, and it ensures timely distribution of investment returns. No human intermediary needs to do anything. The contract handles it instantly and transparently the moment the income hits the account.
Okay. Now we take everything we've learned about the compliance complexity, the valuation divergence, the volatility risk, and those powerful rewards, and we condense it into a practical, actionable framework. You, the listener, need a step-by-step guidance system. So we've built a 7-point checklist to evaluate any tokenized real estate project before you commit a single dollar.
This is the crucial stage. We're moving from theoretical risk analysis to practical protective due diligence. If you are considering investing, you need to pull up the project's white paper, their legal prospectus, their secondary market data, and start checking these 7 essential items.
Let's do it. Checklist item number 1, compliance clarity. We started here, and we have to demand absolute clarity here. Does the project clearly explain its specific regulatory framework, or is it vague?
And it needs to be explicit, not evasive. Is the token registered as a security? Under which specific regulatory body and in which jurisdiction? If it's deemed a digital asset, what are the restrictions on US, EU, or Asian investors? If the explanation is vague or if they hedge their bets, that's where you stop. You have to know the legal status of your asset in your home country.
Okay. Checklist item number 2, legal structure. This is about how the digital token is securely connected to the physical deed, the off-chain value. The key question is there a special purpose vehicle, an SPV, involved?
An SPV is a separate, ring-fenced legal entity, often a newly created LLC or a trust set up specifically to hold the title and deed of the property. This is absolutely vital for investor protection.
Why is it so vital?
Because it provides what's called bankruptcy remoteness. This is the non-generic insight you really need to know. If the deed is held by an SPV, that SPV shields the underlying asset from the bankruptcy of the issuing platform or the token management company.
So if the platform collapses?
The asset is legally separate. It's protected. The fractional owner's investment claim remains intact. You need to know exactly who legally holds the deed and if that entity is firewalled from the platform's own financial distress.
Got it. Checklist item number 3, custody. Where is the digital asset, the token representing your share, actually held? And who controls the private keys that can move that token?
Custody needs to be reputable and, crucially, independent from the issuing platform.
Why independent?
If the platform holds the keys and also manages the asset, that centralization of power is a major risk. An independent, professional custodian adds a layer of security. It ensures that even if the platform goes bankrupt or is hacked, your claim on the underlying asset via the token remains secure and accessible outside of the platform's control.
So what should I ask?
Ask if they use multi-signature wallets or professional third-party custodians, like some of the big institutional crypto storage providers.
Okay. Checklist item number 4, valuation. This goes right back to that on-chain versus off-chain challenge. Are current independent third-party appraisals provided?
And are they updated with the necessary frequency? We established that quarterly updates are preferable, at a minimum annually for long-term holds. But crucially, you need to examine the appraisal reports themselves.
Not just take their word for it.
Never. Who signed it?
Right.
Are they a known certified firm in that specific geographic region? If they only provide a single appraisal from the launch date 2 years ago, that valuation data is obsolete and totally unreliable. You'd be basing your investment decision on dangerously outdated information.
Right. Checklist item number 5, liquidity. The reality check. Is there an active secondary market with sufficient trading volume to guarantee you an exit?
And this requires rigorous checking of those 4 questions we discussed earlier. The volume, the number of buyers, the presence of market makers, and the bid-ask spread. You must demand to see the historical trading data.
If they won't show you.
If they won't show you, or if the trading volume is negligible, $100 a day, you do not have liquidity, you have a locked-in investment. Treat the liquidity promise as unfulfilled until you see hard data proving a consistently active, deep secondary market.
Okay, number 6, checklist item 6, governance. This feels important. Do token holders possess specific voting rights or input on management decisions? This separates a passive investment from true fractional ownership.
It does. This determines if you are simply a passive recipient of cash flow or if you have a real say in the future of the physical asset.
What kind of things could you vote on?
Governance rights might include voting on critical financial decisions. For example, should the property accept a major offer to be sold? Should the platform approve a $1 million maintenance expenditure? Or refinance the mortgage at a new rate?
So it's about accountability.
Clear governance structures ensure the platform is accountable to its fractional owners. If you have 0 rights, you are entirely beholden to the platform's management decisions and, frankly, their competence.
And finally, checklist item number 7, fees. What are the explicit costs across the board? Real estate is notorious for hidden costs.
And you must identify every single fee, because high cumulative fees can severely erode the potential returns of a low-margin investment. We're talking about platform issuance fees, which you pay when you first invest.
Well,
Trading fees on the secondary market, which are often higher than on traditional stock exchanges. And ongoing, often complex, property management fees, which might be a percentage of gross rent or a percentage of the property value.
you need an itemized list.
Demand a transparent, itemized breakdown of all costs before you commit capital. And then compare that total cost structure to traditional REITs or property funds to see if it's competitive.
That is the 7-point framework. And the conclusion to this checklist is simple, and it sounds like completely non-negotiable.
Yes, if any of these 7 points are unclear, if the answers you get are vague, or if the project team refuses to provide precise, verifiable answers and supporting documentation, especially around compliance, the SPV structure or valuation, the investor must pause their decision. These are not optional considerations. They are the foundation of safety in this new, complex asset class.
So what does this all mean for you, the learner? We started by acknowledging the massive opportunity that is represented by tokenized real estate. The accessibility, the global reach, the transparency, and the potential for smart contract automation. It is a genuine step forward for democratizing wealth creation.
And we paired that enthusiasm with a very deep dive into the necessary caution. Tokenized real estate offers incredible opportunities for yield and diversification, but only if the investor conducts proper, rigorous due diligence and thoroughly understands the corresponding risks.
The compliance tightrope that can freeze your assets.
The valuation challenges that can disconnect price from value.
And the potential for illiquidity, even when quick trading is the main promise.
Right.
Your job now, as the proactive investor, is to be vigilant. Demand transparency on every single step of that 7-point checklist.
Yeah.
Never invest blindly based on hype or marketing alone. Remember the fundamental lesson of this hybrid asset. The physical property might be stable, but the digital token you own is still subject to the volatility and the regulatory whims of the digital asset space. Knowledge and preparation are really the only shield against the inevitable volatility of a nascent market.
We've covered everything from the mechanics of SPVs and bankruptcy remoteness to bid-ask spreads and the practical application of the Howey test. You now have the necessary toolkit to critically evaluate any project that comes across your desk.
So we'll leave you with one final thought to mull over, building on all the risks we've identified today. What's the biggest risk you think tokenized real estate needs to solve next? Beyond just liquidity, to achieve mainstream, undisputed institutional adoption.
Is it a standardization of the regulatory frameworks globally, or is it truly resolving that on-chain, off-chain legal gap in a way that courts will universally recognize?
Something to think about.
We'll be back soon to continue our exploration into the financial specifics of tokenized property. We'll be focusing next on the specific tax implications, cash flow generation models, and how these tokenized properties actually generate yield across different international borders.
Until then, stay informed and happy deep diving.
Yuhuu!